is a really interesting question, or at least it is to me. There is actually only one definition in law of an insurance company, and that is that it is a company which derives more than half of its income, more than half of its revenue, from the issuing of insurance policies, annuities, or reinsurance or retrocession agreements. That's it. So that's not a lot to go on. So for further guidance, we looked at case law or common law. First court case about whether or not something was insurance was back in 1941. There have been a lot of rulings since then, and those have evolved to provide some fairly clear guidelines for us now. And I think those can be summarized in what they sometimes call the three-pronged approach when looking at an enterprise program and determining whether or not the entity is an insurance company. First of all, there must be insurance risk. Seems obvious, but the second one is called the risk shifting and risk distribution, must exist. And the third one is that the entity must be run under the generally accepted principles of insurance companies. So those are the three, that's a three-pronged approach which the law will look at to determine whether or not a captive is in fact an insurance company. So looking in those in slightly more detail, the first one, there must be insurance risk. What is insurance risk? There has to be an element of fortuity to it. This cannot be an expense or a liability which is expected or could be expected to be incurred. If every single year you have uncollected receivables, bad debts of approximately $500,000, that is not a risk. That is just part of your day-to-day business. What they're looking for is, and it's sometimes categorized as the 10% risk with a 10% loss. And by 10% loss, they mean 10% of the premium paid. So there must be at least a 10% chance of a 10% loss and an element of fortuity to it. That's not a timing risk. If you know that you're going to incur a liability, you just don't know when, that's not insurance. And just for the record, it's not an investment risk either. The market is going to go up and down. That is not something you can insure against. So the second part of the three-pronged approach must be risk shifting and there must be risk distribution. Risk shifting can best be looked at from the point of view of the insured. Risk distribution is best looked at from the point of view of the insurer. So, looking at risk shifting from the point of view of the insured, what does this mean? Normally, an insured will have certain liabilities on its, which it keeps on its balance sheet, which it records as potential risks. By paying a premium to an insurance company, we remove that liability from our balance sheet. If I'm running a business and I pay premium to a commercial carrier to cover my auto liability, then instead of carrying the liability of possible car damage on my balance sheet, I put a premium as a business expense that I pay to the commercial market, and the commercial market will then have that liability on their books. They are the ones responsible for making me whole. That liability has shifted. If I then decide, instead of placing that liability or that risk, covering it through the commercial market, I decide to have an captive insurance company. If the insured forms a captive insurance company as a subsidiary, it will pay premium to the captive will assume that liability, and the insured's liability shifts from its balance sheet to the captive. However, when the insured produces consolidated accounts, the results of that captive, the subsidiary, are consolidated within that of the parent, and the liability moves back onto its balance sheet. That, therefore, is not a valid insurance arrangement. There is no risk shifting. What we have seen through various court cases, Humana, is that it is accepted by the court that there is risk shifting in a brother-sister relationship. What does that mean? If an owner of an insured company, the owner sets up a captive, so rather than you do the insured having a subsidiary which is a captive, if the owner of the insured sets up a captive, that's a brother-sister relationship between the insured and the captive. At that point, if the insured pays premium to the captive, if their liabilities are assumed by the captive, when the insured creates consolidated accounts, it does not need to take into account those of the captive. And that is acceptable for risk shifting purposes. The second part of that test is risk diversification. And for that, we're going to look at it from the insured point of view. In this case, the insurer, sorry. In this case, the insurer is the captive. For insurance, the point of insurance is to smooth out, is to plan for inevitable risks, to which there is sufficient fortuity, but we don't know when and we don't know how much. So insurance is based on the principle of the law of large numbers. So if I pay premium every year for house insurance and my house burns down in 3 years' time, that premium is probably not going to be sufficient to cover the damage of my house. However, if I'm an insurer and I'm collecting premium from millions of householders and approximately 10,000 of those burn down, then premium, the law of large numbers, there is sufficiently large volume of premium to be able to cover those costs over time. And that is the principle of risk diversification, which courts will look at to determine whether or not your captive is being run. Does it have sufficient risk entities, risk units being insured for that to be viable insurance? The third principle is whether or not the captive is run under the terms, the generally accepted notions of an insurance company. So what are those? Well, the first one is it's got to look like an insurance company. So it's got to be licensed like an insurance, as an insurance company. It has to be capitalized as an insurance company. It has to conform to the terms of its license in the domicile in which it's created, and it has to maintain good standing. The second thing it must do, it's got to issue insurance policies, and those insurance policies, they must be legally correct language, they have to be issued timely, they have to confirm coverage clearly, identify the coverage and the premium that's being paid for that coverage. The third requirement is that captive has to be established for the purpose of insurance and not simply as a tax advantage. If the court sees no other reason for establishing a captive as a tax advantage, that is a not good enough reason. It will not be deemed an insurance. Fourth reason is, how do they handle their claims? Do they adhere to robust best practices? Are the claims notified promptly? Are they reviewed? Are they confirmed as covered to the terms of the policies enforced when the claim either has occurred or was notified? Are they paid promptly? And the last one is, it needs to be run like an insurance company. It needs to make sense. So a good example of that might be that you may have, the captive insurance company may have some capital, some surplus. How do you invest that? How do you invest the premium that's received? If you put it in the bank, term deposit maybe, 3-month term deposit, if you invest it in easily liquidated assets, so that as and when claims come through, notified, they can be paid timely, that is reasonable. If you take that money, you invest it in a plot of land somewhere that will be developed over the next 10 years, it would suggest that you're probably not expecting claims. You probably don't think it's proper insurance arrangement. It's not the sort of investment which a real insurance company would make. So there are aspects like that which the courts look at as well, just to see, is it run in the way they would expect